Monday's here, future party. Grab your iced coffee because we're diving into some big news that's shaking up Hollywood. David Ellison just snagged Warner Brothers Discovery in a deal that's got everyone buzzing. Picture this: a bidding war that ends with Ellison controlling one of the largest media empires in history. It's like watching a high stakes poker game where the stakes are a whopping $110 billion. So, what's the scoop? Ellison, son of Oracle founder Larry Ellison, has gone from running a small studio, Skydance, to becoming a major player in the media game. At just 43, he's got the chance to build a studio that could rival Disney. That's like going from being the kid with a lemonade stand to owning a theme park. Now, let's break down the numbers. Warner Brothers sold for $31 a share, a big leap from Paramount's initial offer of $19. The Ellison family and Redbird Capital Partners are throwing in $47 billion in equity, while the rest is coming from some heavy hitters like Bank of America and Citigroup. But hold on, there's a catch. This deal comes with a hefty $54 billion in debt. That's like buying a mansion, but realizing you've got to pay off a mountain of student loans too. And what's the plan moving forward? Warner Brothers is aiming for at least $6 billion in cost savings. Think of it as a Hollywood diet: cutting the fat, consolidating real estate, and yes, layoffs are on the table. The deal is expected to close by the third quarter of 2026, which is pretty speedy for such a massive acquisition. But don't think it's all smooth sailing. State attorneys general might still throw a wrench in the works. In a twist, both Paramount and Netflix saw their stocks rise after the news broke. Paramount jumped 20%, while Netflix climbed 10%. It's like watching two teams celebrate a touchdown after the other team scores. Everyone's happy, even if they didn't win the game. Now, let's talk about the future of movie going. Ellison promises to keep the studios running independently, with each releasing at least 15 movies a year. He's betting that more movies will mean more people in theaters. It's like throwing a party and hoping everyone shows up for the fun. Switching gears, let's chat about Jack Dorsey and his company Block. Last week, he laid off about 40% of his workforce. That's a big cut, especially for a company that's doing well. So, what's behind this drastic move? You guessed it: AI. Dorsey claims AI has made his employees more productive, but it's also made many positions obsolete. It's like when you realize your favorite video game character has been replaced by a new, cooler version. Instead of dragging this out with multiple rounds of layoffs, Dorsey ripped off the band aid and offered a solid severance package. Block is now looking to operate with smaller, flatter teams that are AI driven. And guess what? The stock jumped 20% after the news. Shareholders are clearly on board with the idea of cutting costs while still aiming for growth. But this isn't just a Block issue, it's a trend we're seeing across Silicon Valley. Companies are looking to AI to streamline operations, and it's raising some eyebrows. Some experts are even suggesting that we might need to rethink how we support workers in this new landscape. The World Economic Forum predicts that while 92 million jobs could be lost to AI by 2030, 170 million new roles will emerge. It's like a game of musical chairs, but with a lot more seats being added. As we wrap up, it's clear that the media and tech landscapes are shifting rapidly. With Ellison's big win in Hollywood and Dorsey's AI driven layoffs, we're witnessing a transformation that could redefine how we consume entertainment and work. So keep your eyes peeled, future party, because the future is unfolding right before us.